Welcome to the DCO Podcast, where we bring you stories from founders and investors in Web3. Before we get started, this is not a financial or legal advice. It's just a conversation about things we find interesting in Web3. Views expressed are our own personal opinions. DCO members or guests appearing on the show may have positions on assets they talk about. Alright, it took us about 20 episodes to get here, but we are finally on video. And brought a guest for the occasion. Joel and I are talking to Arthur from Defiance Capital. He started investing in TradFi markets little over a decade ago. From 2017 onwards, he started applying his learnings from TradFi markets to the crypto markets. Arthur came on my radar back in the day when he wrote his thesis on synthetics. I think that was sometime in the bear market of 2018. Since then, I've been following him and I've learned a lot from him. In this episode, we talk about liquid versus venture investments, Ethereum and L2s, the future of DeFi, role of narratives, about being cynical in crypto, and much more. I hope you have as much fun listening to the episode as I had while recording it. Okay, on to the episode now. All right, welcome to the DCO Podcast. It took us 20 episodes to do this on video, but here we are. And I think it's fitting that we are doing with one of the legendary DeFi folks in crypto, Arthur from Defiance Capital. I think the first I came to know about Arthur was about the report that he wrote on synthetics. I think that was way back in 2018. It was a massive 35-40 page report at that. I don't know how many people went through, but yeah, that's when I came to know about him. And since then, I've been following him and learning a lot from what he posts on Twitter. Yeah, welcome to the show, Arthur.
No, thanks for having me. Yeah, it's a pleasure.
Let's start there, right? Let's start with your background, because when I was trying to research about you, I came across this YouTube video that was uploaded 10 years ago. And I think it was about 5 to 7 minutes video where you talk about your investing approach into equities and stuff like that. And maybe you were 19 back then? I'm not so sure. So yeah, just walk us through your investing journey.
Yeah, so that interview was during 21 years old, and one of the local media want to feature young investor. And since I was very actively involved in the investment club of my university, I was participated in giving one interview as one of the younger investor out there. So I've been starting to invest in the stock market since 19 years old, just to really get a feel of investing, finance, and have been a very strong believer in financial education since I'm young, because I think that coming from a very average middle ground family, I think financial issue was constantly a source of argument among the parents. So I think that this is just one of the key issues that we should, get it managed in order to have a better life. Yeah, and then I studied economics, and then just been always in with a small amount of savings to learn about markets, investing as a whole since then. And then when I graduated, I always continue to invest and learned about crypto in 2017, and fell into the rabbit hole and just been really mainly focusing on investing in crypto since then. Yeah.
What was the transition like? I mean, you must have started in traditional markets and then you went to crypto, right? So at first, what got you? I mean, I get that there might be some financial issues that you wanted to overcome, and that must have been the major motivator for you to get into finance. But other than that, how did it pique your interest? And then how did you transition to crypto?
I think that was in 2017 where Ethereum really become very popular and big. And I'm fascinated by the potential of building all sorts of decentralized application on top of a blockchain, which was not possible previously. And when you look at the opportunity in crypto, it also stands out because, first of all, crypto is a global market. It is not isolated to any geographical region. And that is in itself a pretty unique situation. And there's also a lot of growth, and the industry was still relatively young. So it is more possible for a new entrant to make a bigger impact. When you look at the other market, often you need to spend a lot of time to gain a lot of experience to really have more impact and on the level playing field with the existing player. But I think crypto is just so young and new, and it just offers a lot of the opportunity to the more adventurous kind of people. And then that's just how I found crypto. And yeah, obviously the returns, the potential of having a very outsized financial returns in a short amount of time is definitely one of the factors as well.
Okay, so one question related to TradFi before we get into crypto, right? So, like, I have studied some finance during MBA times, and you've read like a bunch of books on finance from Ben Graham to probably Ashwath Damodarans of the world. And we talk about all these models like DCF, etc., where a key component is the discount rate. And like, how do you reconcile that with what's happening in the real world? Like, the rates are probably zero. They were zero some time ago, but now they aren't. But it is likely that they head towards zero or even negative for some. So how do you just reconcile these differences when you are investing versus when you're studying finance?
Yeah, I think this is something actually all investors kind of learning for the first time, right? Because before the financial crisis, like during 2008, like the zero interest rate phenomenon wasn't something people think that will last for a long time, for a sustained period. And the thing is, we have kind of a long period of that post financial crisis, and it has the effect of really doing illiquid investment more popular because your discount rate is so low, and you're more willing to underwrite risky investment. And because you require a lower rate of return to compensate for this, and you can't even get 2-3% from going to a very safe investment. People are more incentivized to go further on the risk curve to get the count 7-8% return that will fulfill their portfolio need. I think that probably explains partly why the past 15 years there was a big shift into all the illiquid PE VC investment. I think the whole alternative investment space, especially on the illiquid side, have grown significantly in the past 15 years. Yeah.
Actually,
so I think it has the incentive of pushing people to really chase the illiquid and the risky investment.
So one thing I noticed is there's likely a correlation between low interest rate phenomenons and an interest in crypto. So like a few years back when I first went to Singapore, I saw crypto.com offering maybe 4% interest rates at a time when Singapore was offering zero. And that's why a lot of people were flocking to crypto. I don't know what the interest rates are like in Korea or Japan, but there's also a high, curiosity for crypto as an asset class, probably because of similar low interest rate phenomena, right? People just don't have a place to make yield.
Yep. Yeah, and also because you are going to get 0% in the bank, and anything above that, you are just going to be more interested to find out more about it, and explore it.
Yeah, so another thing that I wanted to ask you was, I think in one of the interviews you mentioned that you've become more cynical because of crypto, or since you are in crypto. I don't know whether there is a causation there, but there's definitely some correlation.
The 3 hours play a role in that.
Yeah.
So, and I think I've observed something similar in Joel also, right? Joel also
that's because of FTX. 100%, right? That's also what I was asking you. Was it because of 3 arrows?
Yeah.
So can you just unpack that as to why more cynicism?
Yeah, I think that is actually not just really because of FTX or 3 arrows. I think it is probably a maturation of every single market participant or investor over a journey. I think even if you participate in a traditional market, you are likely to have the same kind of journey, but you're probably going to experience it a lot earlier. I would say because traditional market are like much more competitive, and you're just not going to see it you're going to see people like being very competitive since the beginning. And I think in crypto, it's just that because most of us join beside the fact that for the potential for outsized financial return, it's also because of the ideal, right? Like decentralization, censorship resistance, like the more distributed ownership of certain like technology, your data, identity, etc. So the thing is, when the longer you spend in crypto, you realize that there's a lot of these challenges, that of all these notions that sounds very good in theory, but when it comes to implementation, there's just a whole lot of issue, and that doesn't seem likely to be resolved. And you also see, because crypto has such a low barrier entry, but it's such an interesting topic. You get a very extreme variances. You get the brightest, smartest, the best hopeful people, and you also get the most bottom tier, scummy, opportunistic grifter to join the space. And that lead to a situation that just a lot of things that you see just was never likely gonna be sustainable or materialized in the first place. So I think that as the time goes, you just realize that there's too much empty false promises, and you are gonna be slowly more cynical. But I think that beside on the point of cynical, I guess you guys mentioned in one of your writing, which I highly recommend, I really love reading, is to be a cynical optimist. Right? I think that's how you really balance it. You should not take everything at a face value, but at the same time, you should not like just dismiss any potential for any new technology primitive to emerge. And then there's a very fine line, and I think that not many people can do it well. Usually you fall on one side of the spectrum. I think usually the most of the VC, they are obviously on the more optimist side. And then you see the more trader people, especially I think the last 6 to 12 months, is people get really cynical. And so I think that really having a very balanced view on this is important, but you can't be just purely optimistic. And I think that just set ourselves to be, attacked or captured, like exploited by certain players. Yeah. I think in that sense, Bitcoin community actually, for probably cultural reasons, have always built up a stronger anti-grifting kind of thing. They obviously they are very close-minded to most things, but that also kind of prevent them from, giving the platform and the space to all these kind of scams and etc.
So I think that's because of the Lindy effect of Bitcoin, right? It's been around for like 15, 16 years. If you go to like 2012, 2013 Bitcoin Talk forum, you will find a lot of scammy, funny players there. I feel like a lot of people lost tens of thousands of Bitcoins, to funny actors in Bitcoin, and they learned the hard way to just be massively skeptical, right? You see elements of that with ETH today, and maybe a few years out, you might see the same with Solana, is what I would say. Maybe Solana is still in its optimistic, hey, let's all been together phase. This might just be a common thing with all idealistic technological evolutions, right? Early on, you just think, hey, we believe in the same things, that's why we're brothers. And then you realize the sharks eating into your meal, and then you just realize, it's time to be cynical.
It's common traits for most crypto people to think that they have they discover a new world where the old rules doesn't apply, but very often it's not the case. I'll give 2 examples. One of that is the governance in general. I think crypto enables some new method of governance, but I don't think it also probably speed up and then make the whole coordination more effective, and you can put an incentive to coordinate certain behavioral actions you want. But it doesn't fundamentally alter humans' behavior. And I think that lead to a lot of like all of this DAO governance and etc. I think it's just a lot of time we're just not really applying sufficient lessons that the traditional world, like whether in politics or in corporate world, have learned over the past 30, 50 years. We are just like speed running the whole learning again. And another thing is the finance. I think obviously back in the DeFi days, we all think that, we found like the alchemy of finance. We can create yield from thin air, and it can last for a very long time. And that turned out not to be the case. Yeah.
I'm curious whether being more cynical allows you to manage risk better. Like, how does that materialize?
Yes, I think that in some way, yes, it definitely, help you to think more about the downside and, the chances that it can go wrong. But I think that this is basically a required qualities for all investors, especially in the liquid space. Yeah, because you do need to manage your risk.
Arthur, do you want to talk about a specific investment where your cynicism saved you? I can talk about where optimism burned me, if that's helpful.
Is that Frentech, Joel?
Yes, obviously it's Frentech, right? I was just massively excited for what it represented. Obviously it burned me. I bought in more at every point. It was down 50%, thinking I'm dollar cost averaging. But then like later on, I was just doing my own postmortem, and I just realized that the signs were there all along that it's a bad bet. So just curious, maybe you don't want to give me the ticker, but a case where you said, all right, just passing on it was good for me.
I think there's too many examples, and you generally don't spend too much time. You just like that. You dodge a bullet. And I think just in general, investing as a whole, right? But most of the pitch you receive and investment opportunity you receive are not going to give you a good outcome. I would say probably 90%. And then even the 10% that you end up committing to, there's probably still like 10% of the 10% are the one that actually going to give you the return that really justify the risk you are taking. Yeah, I think there's just too many. I think in crypto, we can actually have like a long list of things that you should have avoided and you're glad you avoided. I don't keep a list, but I'm pretty sure there's plenty of them. And actually, in a way, this is even like more important than people realize, because if you get involved, even though for the first few years, it is a good thing, but because you have a vested interest, you are likely going to be doubling down your commitment and lead yourself down to a path of no return. So sometimes having the kind of like wisdom to outright, pass it in the first time, so you don't end up continue to commit to this kind of sinking ship, is also generally a good action as a whole.
Are there any general patterns you've noticed that you could share, or things that just come off as grifty, or things that you absolutely want to avoid?
I think there's many. I think it's not exclusive to crypto. Like people with the right character intentions are willing to take feedback, rectify the issue. I think probably one of the biggest red flag is just like project teams and whatever, they are just not incorporating feedback, whether it comes from the community, come from the market, in various aspects into them. Yeah. So I think people who really just, do things in the same way and regardless of feedback are generally a red flag. But obviously there's a fine line between founders who are, stubborn but stick to something until the end. But let's say we point out some practice that is likely be damaging to the public, but they're still not being rectified. And then I think that is generally a pretty big red flag.
Gotcha.
Like Defiance on the website itself, I say that bridging East and West across digital asset frontiers. Why is it critical to bridge East and West? Like, I'm curious about what the thought process is.
I think this is one of our biggest edge, because crypto is a global industry in nature, but you actually see very different kind of mindset and thinking between the East and West audience. Obviously, the asset that are able to form the consensus among both the East and West are usually the platform to thrive very well. And I think one of the underrated attribute of Ethereum is actually Vitalik at the beginning, and Ethereum community as a whole at the beginning for the first few years spent a lot of time in Asia, especially China, to really like promote the platform, the technology, the ideal. And so they get a huge kind of acceptance from the Eastern community. And obviously, it continued to do very well in the Western community. And in fact, I think that the first tranche of funding for Ethereum was provided by Parasitic Capital, if I'm not wrong. It's a Chinese VC. So I think having been able to really understand the perspective of both and synthesize them is a big source of advantage.
Yeah. So how do geographies play a part in letting people form their investment thesis? Like, I'm curious whether it is cultural, like what is that difference?
I think the difference is the way that the part of things that you focus on. I think let's say for the Western community, there tend to be a lot of focus on the tech itself. But let's say on the Eastern side, we probably beyond the tech, we will look at more on the background, like who is backing it, and what's kind of the distribution it has, what kind of, beside the tech, what kind of advantage that this project has that can make it outcompete the rest. I think this is something that sometimes in the West, we kind of think that technology and product are the only thing that matters. The rest is just secondary. But I think in the East, people recognize that there's a lot of other factors beside the tech itself that can make a big difference to the outcome of the project. Yeah.
Joel, you have any follow-up?
Yeah, I think one way that this is translated to a panel at Solana is that the West has the tech and the East has the users, right? I think part of why East adopts so much new tech is likely a mix of need and desire for novelty. I think the regulations are just blurry enough such that you can actually tinker with new technologies in these markets more than you could probably in the West. I think a different DNA that I've seen is a lot of founders that come from the East think a lot about distribution, whereas a lot that come from the West are obsessed with the tech. So now you have like layer threes with, I don't know what is going on at this point with, economic security and all those cool things, but there's like 12 people using it. So if you look at any report that looks at adoption, it's almost always centric around the East. Even if you look at consumer apps like Play to Earn, you look at things that's happening around this interesting company called virtuals.io. All of them actually are all centered around Malaysia or Vietnam. Like these are the two big hubs that I've seen where great consumer applications have consistently come out in the last few years. And it's like, to Arthur's point, there's also massive, compared to companies in the West, these firms receive less dollars. So there's definitely an opportunity there to get better investments with lower sums of money. That's the arbitrage, so to speak, I would say.
Yeah.
And when you say that you're bridging this gap, like how exactly are you doing that?
I think it's just that as an investor, we are really able to understand the perspective of both the East and the West. I mean, Singapore is a very global city in nature, and we speak English most of the time. And I'm very active on X, and which I think most of my followers are actually from the US. I think I went through the analytics. I think 60 to 70% of my followers came from US. And like Asia is probably only 10-20%. But we live here, we speak all the Chinese founders, investor, participants. So it gives us a very good balanced perspective and to really be position ourselves accordingly in the market. And also from an investor perspective as well, like from also the institutional builder perspective.
So just adding one thing here, right? When the internet was taking off, there was a similar period of asymmetry, so to speak, where people were looking at China, India, and the gap that it had in terms of catching up with the US, both in terms of infrastructure and user behavior, right? Like India adopted e-commerce relatively slower. Even Uber and its competitors came to like India relatively slower. And I think it's kind of similar things happening with crypto right now.
Yeah,
like there are funds that were based only on China and they just had stellar returns. So there's a section in The Power Law, which is a book by Sebastian Mallaby, which looks specifically at just arbitrage in that.
Yeah, exactly.
Another interesting thing about what you've written is liquid venture investments, right? So I want to talk about liquid versus venture and why liquid venture investments.
Arthur is excited.
Yeah.
You can see him inspired.
Yep.
I think this is a very clear at this point that we have an overabundance of private capital. We have a lack of professional capital in the public market. I think it's almost like a consensus at the moment. It was not when we published the thesis and when I started talking about it 2 years ago. I think the whole capital imbalance just create more opportunity, right? Because as an investor, I want to be on the side where I have a choice to make. And I think the problem is that in the private market, I think VC, the situation have corrected a lot. But in general, the VC have still pretty overfunded relative to the quality of good project, right? So you are seeing really good projects are still being able to command very good, very high valuation and raise a lot of money, like more than 100 million kind of raise that even in a traditional startup market, it will still be considered a hugely successful raise. And this is 2 years after FTX, all this thing, and we are still seeing this kind of thing happen. I'm not saying it's a bad thing. I'm just saying that from an investor point of view, my competition on the public market is a lot lesser compared to the competition on the private market. And from a pure market structure point of view, in crypto right now, we actually have something that's inverse of a traditional market. In a traditional market, the capital market evolved in a manner where it's retail heavy. Actually, all capital market started from retail heavy. But the US, they went through a different wave of professional investor participation. What started was the mutual funds that actively pick stocks and invest. And then you have hedge fund starting to become more popular. In the last 15 to 20 years, you start to have VC and PE becoming more and more mainstream. But when you look at the total capital managed by different investors, hedge fund and the mutual funds or the ETF are still way bigger than private equity and VC combined. Like I think, I don't have the exact number, but I think the ratio is at least a few times. But in crypto, I think we kind of get the opposite. You actually have, we count the VC are managing 3x more capital compared to crypto hedge fund. We are excluding the passive tracker like Grayscale. We're only including actively managed crypto hedge fund. The VC AUM is 3x of hedge fund AUM. So what happens is just by, unless you assume the retail mania will come back, it's mathematically impossible for all the, the hedge fund to absorb all these VC investment. Like we have enough money to create an exit for them. And so on balance, you're most likely not going to have a profitable investment. I know VC is a very power law business. You hit one big one, it should cover the fund. But I think the exit will become harder and the valuation will continue to compress. And I would just much rather be on the liquid side than venture side. And the second thing is the capability of able to manage risk, especially on a sector basis. I think one thing that is very obvious right now is crypto is a very fast moving industry where things can change and you need to be ready to adapt. But again, it's a fine line of, being just a market participant with no belief in anything, but having the mental agility to adjust to different views. It's hard. And I think that's actually what separates a good investor and an average investor. Like, you need to be able to adapt to new information, but you need to also have a core set of belief. And that is really tough. And not that many people can do it well. Let me give an example. So 2 years ago, and when NFT was all the rage, it was also the likeliest that after DeFi or even more than DeFi, it probably seems like the only vertical that can bring the most mainstream adoption, right? We have all the celebrity rocking and Bored Ape, and we are seeing all this kind of like big company trying to experiment NFT, trying to tokenize various things as an NFT. And then what happened right now, 2 years later, the NFT sector is probably worth 5% of what they used to be worth. And I'm not saying the sector is dead, but as an investor, you actually should manage your exposure accordingly. And I don't think as a VC you're able to do that, right? If you make a huge bet, you put 1/3 of your fund into NFT sector, that entire basket is likely worth close to zero at the moment. Yeah, unless you hit Yuga Labs or you hit Blur, OpenSea. I mean, I think just speaking for a number, right? NFT volume, sales, primary sales, everything is just down 90+%.
So just giving raw numbers there, right? Sorry, Saurabh. NFTs were making, like, OpenSea was making about $3 million a day in royalty, like 2 years back. Today, it's making close to $200,000 a day in royalty, right? So it's like down 96, just adding to what Arthur was saying. Just looking at the numbers day before yesterday, right? Similar phenomenon was there were a lot of gaming specific that were popping around the time. I'm presuming or hoping that most of them did not deploy their money because I don't think in the last 18 months there were as many, gaming specific opportunities that emerged. So yeah, I think VC is quite thematic. And if I would look at what is happening today that is similar, maybe it's crypto X AI. I don't know any fund that's raised specifically for that. Maybe somebody is racing, but yeah, just saying there's always a hot new thing every few quarters.
Yeah, and I think that I don't blame the VC, right? As a VC, you have to invest because what if this sector turned out to be the next 100x thing that came out from crypto and you can't afford to miss it, right? And I mean, even for us, Defiance, to our first fund, we did a lot of these venture investment into the gaming side, especially. But it's a hybrid fund, so we have the liquid book that we can manage exposure. But the problem is if you run a pure VC fund, you will not be able to manage all these risks at all. Like you are gonna ride to the end with all these venture investment you have made in the past. And I think in traditional VC this also happens. I mean, this risk exists in traditional startup, but you at least you have some sector that's a bit more proven. Like it probably like let's say enterprise SaaS, right? This sector is not going to go to zero overnight. Like it's probably not going to correct by 90% in 1 year. Like at most we're going to see like a 30% contraction over 2 years, and you're going to see a re-rating of multiple. But you're not going to see the entire sector becoming virtually uninvestable in 2 years. But I think this in crypto it does happen. Like the entire sector can become uninvestable or just no potential for giving any justifiable return for the foreseeable future. And as a liquid investor, you are actually able to manage the risk. And actually that's also what brings me to crypto in the first place. Like the first principle thought of crypto is I'm able to get a startup kind of return, but still being able to manage risk like investing in the public equity market.
One sector that does feel like it could be uninvestable within 2 years is probably AI, because a lot of the AI companies are at ridiculous SaaS multiples, and there's also drastic reductions in cost or competitive advantages that come out of like LLM improvements and the like, right? So maybe we see a slew of dead companies there, possibly, at least on the startup side. A second thing I wanted to ask is, Arthur, when you say liquid investing, how much is it closer to a hedge fund where you're able to take in positions and leave whenever you feel like, versus a private equity fund where you take in a position and you also have to prove your value, to the team that's involved? Is it that a lot of teams don't consider liquid funds seriously because they don't see value from them? And, if that's the case, then how do you differentiate?
I think it depends, because even for liquid funds, I mean, different managers have different kind of investment horizon. And I think that the range can be as short as 1 month kind, a more hedge fund, definitely closer to trading, or somewhere up to they will at least underwrite the position for 1 to 2 years at least, So yeah, for us, I think we sit more in the middle. We generally try to aim for something with the thesis that will take multiple months or quarters to play out. But obviously, we will manage the exposure and accordingly if we think that our investment thesis are invalidated. And I think that so far, actually, the feedback has always been positive. I think that it's just that the industry is just not mature enough. This is actually, again, bring back to what I spoke in the beginning, right? A lot of time, crypto is just speed running, governance, corporate finance. I think it's the same thing. It's a bit like an IPO where it's very common for any company to go public to talk to public investors, because these are the people that are going to buy your token or stocks after you get listed, right? But in the past, in the crypto, this never happened, right? Because it's basically, okay, you get a market maker, you get an exchange, you get listed, boom. Then the retail mania come, they push your price up by 5x, 10x, you're happy.
So how are you seeing this evolving? Because, again, as a publication, we see how there are some participants that are exclusively focused on investor education. But, as somebody on the buy side, are you seeing teams, changing their pitch when it comes to just going live, on an exchange? Are you seeing anything that's drastically different with tokens that are becoming liquid at this point?
I think we are starting to see, but really, really early stage of this, because so far, the one that dictate the pricing are still largely the exchange and the market maker, because the biggest exchange, they have 100 millions of retail, so you still generally market to retail. The exchange are marketing the retails. So, but I'm seeing as the current market continue, the retail are not really as much as they used to be. We are seeing more and more projects start to talk to liquid funds, especially those who already have a token on the market, to just get a sense of a feedback. Hey, what do you think about our project? Is there anything else you like to see? What do you think we can improve on? I think we are starting to see this happening, but very, very...
Okay, I think I have a question related to what you said now versus also the liquid versus venture stuff. So because there are more venture dollars these days, the project valuation by the time it launches in public markets is significantly higher than what it used to be in the previous cycles. And as you rightly said, there is no marginal buyer at those valuations, right? Multiple $1 billion of FTVs. So the price discovery typically happens on the downward side. And since price access, because we don't have great consumer grade products, price access, one of the critical marketing tools for projects, and when the price has been down only, it becomes difficult for teams to execute or sustain it and whatnot. So the question is do you guys suggest teams, or are you of the opinion that teams should have certain valuation marks and launch slightly below those when they are launching in public markets? How do you think through, and what are your suggestions for founders or teams that are building and thinking through raising and valuing themselves?
Yeah, so I think raising, there's a few things you think about, right? I think you don't want to raise too low as well, because that also sometimes doesn't send the right signal about the quality of the project and the kind of incentive that you can use, right, to incentivize certain activities on your product. So I think it's not that hard. You just do a benchmark comparables, and you should launch at a level that the public market should be able to get some upside, the public market investor, if you execute well. Yeah. So, but so I think it's not that hard. Let's say you're not. Just give an example. Let's say you're launching a very, very competitive, high-profile layer one that you think if you execute everything well in 2 years, you'll be able to compete with Aptos and Sui. This is just a very ballpark estimate. I would say you should probably launch at something like public, 500 million, not more than $1 billion. I think that's kind of how do you think about it? And when you see all the other successful, fairly successful layer one are trading at 5 billion valuation, so I think that's kind of the thing that I'm thinking about. Yeah, I'm talking about on a fully diluted basis. Yeah.
Right. But then we haven't seen those examples, right? I mean, mostly when the project launches, they are at
2 or 3
higher than, I mean, if you're saying that, if you're saying that L1 should be at around 500 million, then we are definitely missing the mark, because several projects that are not L1, and I think that is probably the largest TAM that a project can command, they are launching at $3, $4, $5 billion. So it's
this is not this issue is definitely not fixed yet. Yeah.
I think for a lot of liquid players, the meta isn't just waiting it out while the valuation bleeds and then going in for opportunities as of now. But I think as the market learns that, hey, we need players that provide liquidity at the right valuations, and exchanges should not be the only one determining valuations at which things list, we will likely see a more mature, liquid fund ecosystem, so to speak, emerging, right? And I think that is likely what will stop tokens from going down 90% after going on Binance, right? If you look at a lot of the large tokens that listed this year, they're all like down 70, 60% at this point.
And I think another thing that I would like to point out is I'm not really like placing a lot of this blame on like just on VC alone. I think that they certainly play a role in anchoring the valuation too high sometimes, but it's also a lot of things have to do with the exchange, right? I think that the even at the moment, after so many things, I think that when you look at the past 10 years of the history, some of the biggest events of the industry always have to do with exchange. And I think even at the moment, we still can't completely escape from the impact of the exchange. I think the thing is, exchange also have incentive to list a project at a high valuation, because a lot of time they come with a launch pool incentive. Like the project are giving them like 5-10% supply as a kind of a listing fee, right? And with a high valuation, these incentives are worth more and to their user. So exchange are also incentivized to anchor the price high. And then when they bleed, it doesn't really matter, because those incentives have already been paid away to the user, and the user have sold the airdrops, all the thing. So the exchange play a pretty big role in setting the pricing as well, I think.
There are 2-3 things that we can get into, but I think this is a good time to talk about, Joel, the article that you wrote last year, the narrative wedge. And I think something that you and Arthur have like intersection of interest, right? So Joel, I want you to give the brief of what the article said and what was your thought process back then. And then Arthur can chime in.
So the narrative wedge is this idea that all markets run on narratives. And, you need some fundamental core ideas that your product or venture anchors on, so that people categorize you within a broader bucket, and that drives in liquidity. So what I've seen is attention and capital is kind of like a river stream, and you can either flow against it or with it, or think about it as the wind and sails, right? If you think smartly about positioning and narratives, you can be in the right place to ride that liquidity of both capital and attention. And I think both are very correlated, because if you don't have attention, then having a lot of capital inbound does not mean much. And if you don't have capital, then you won't be able to make much use of that attention. So a very good instance is AI right now. There's a lot of consumer attention that's going into it. And that's why firms building on AI tend to raise capital abundantly, and then they just keep rotating that into more users, right? Obviously, that should eventually translate into a meaningful user base. It should also translate into returns, or if the game just falls apart. So to take Arthur's point, maybe we saw that with gaming, maybe we saw that with NFTs, and maybe we'll see that with CryptoX AI right now, right? So that's the broad idea. It was just a note to founders saying you cannot be entirely disconnected from where the narratives are, and you also cannot be entirely building firms just on narrative basis.
Yeah,
so that's like a middle ground. And Arthur loved it, by the way. He distributed it a lot for us, and then that was like a landmark moment for a lot of people just discovering the newsletter. So thanks, Arthur.
This is truly one of my best read of the year. I think just perfectly encapsulate like what really drives the market in terms of certain belief. It's just a very perfect observation of the market that I think a lot of people kind of subconsciously understand, but have never been able to articulate it clearly in a written format. Yeah. And I think that this is even especially true in crypto, because there's a lack of valuation framework. People are really in this industry to invest in the really cool, groundbreaking things. So as long as something has shown the potential to be world changing or like paradigm shifting, that usually get an upsized kind of like a attention, capital and resource, even though it's unproven. I think it's just like how it works in crypto. Like another example, obviously the sample size is a lot more isolated, is data availability, right? When Celestial launched, I mean, they did almost like a 10x in the public market. It corrected down, obviously, but DA as the thing is, people think that, there's a lot for DA, and it just went crazy. But I think right now there's obviously a lot more skepticism on how much value can the DA layer accrue in the long run. Is it like a race to zero in terms of the fees? Yeah, so that's why you have seen the valuation have corrected down as well. But I mean, if you are able to really have a strong understanding of the DA technology and think that, at least this is going to be a core part of the modular architecture stack, then yeah, it definitely makes sense to really go heavy into Celestial or other DA solution very early on. Yeah.
Joel, do you have a follow-up? Otherwise we can move on to...
Yeah, I think just talking in terms of the price action on Celestia, right? Celestia was probably trading at $2 at some point. And then as it became the narrative, I think it went all the way around $17, $18 at peak, if I'm not mistaken.
Close to over 20.
Right? Over 20, right? Yeah. So that's a very good instance of an asset being maybe undervalued for a good while, but taking that narrative wedge to go to a new high. And I think my favorite among this is Fetch. It's favorite because I was close to that story. It was accelerated by Outlier Ventures, where I used to work a long time back. It was trading at around 6-8 cents for the longest time, and it caught the narrative tailwind around AI, and it was at 1.8, 1.2 at some point. So just interesting to see these things.
Okay, another narrative that I want to talk to you, Arthur, about is this hypothesis or a question that are L2s parasitic to Ethereum. I will tell you what I think, and then you can correct me however you like. Okay, so before blobs, like, there was certain rent that L2s were paying ETH, and whatever the MEV and the fees that they were getting from users, they were capturing. And I think some decent portion of that was going to Ethereum, right? Since blobs, that has gone down by more than 90%, almost to 99, 98, 99%, the cost that L2s pay to Ethereum. Now, you can think of this as analogous to how cloud service providers like Amazon dropped their rates as storing data became cheaper. But that drop was compensated for by higher demand for cloud storage, right? Across the board, we started seeing that cloud storage is a new standard, and almost every company now leverages Amazon or other cloud services in cloud storage service in some manner. The problem, if I were to apply the same logic and say that the 98% reduction in fees to L2s will be picked up by the demand for L2s. That demand is so huge, I'm uncertain as to whether that demand will ever be fulfilled. That is first. And second, L2s also have a leeway in the sense that they can time the market, in the sense that they don't necessarily have to go and bid for every blob on each block, right? I mean, you can pick and choose as to at what point you want to post your data onto Ethereum, right? So you can game the gas fees, etc., all those things. So yeah, I mean, unless you are bringing all the MEV on the L1, and L1 is now sequencing blocks and everything for L2s, it seems that L2s have at least so far been parasitic to Ethereum. So yeah, I mean, now it's open for you.
No, I think you are absolutely correct. I think whether L2 are parasitic to L1 is this very simple filter, right? Like, okay, first of all, L2 are, I think at the current moment, are parasitic to L1 from a demand for ETH as an asset point of view. Because although the fee have dropped, but I think a lot of times L2 are actually capturing the existing user of the space. It's not really bringing more new user that actually requires one ETH as an asset. So while the technology has improved, the scalability has increased, this doesn't really translate to more demand for ETH as an asset. So the way for L2 to not be parasitic to L1 is, like you say, the increased scalability actually open up and expand the market size so much. This actually increase the demand for ETH that can offset the reduce in the fee that the L2 are spending on Ethereum. Yeah, but this magnitude need to be very big, and at the moment it doesn't seem, we have no realistic path of getting there in the foreseeable future. Yeah. So I mean, we haven't worked out the kind of sensitivity, like how much does the layer 2 usage have to increase to really be able to increase the gas demand for ETH or mainnet again. But another new research that we have saw recently is a lot of the L2 fees, that the sequencer revenue, actually came from the priority fee. It's a little bit of MEV as well. So actually, there is no reason the L2 will want to pass this fee back to L1 because you're the execution layer, right? You're only doing the DA on Ethereum. So in that sense, like the only way this can be offset is the new user that the layer 2 brings in really will continue to demand ETH as a collateral. So this actually brings back to a more philosophical question, right? If Ethereum is going to continue to double down on a roll-up-based scaling roadmap, it's more important than ever to really cement the status of ETH as an asset in the entire ETH L2 ecosystem. Like this should not be negotiable at all. Like ETH should be the number one pristine collateral. Like is the money. It has to be the money inside the L2 ecosystem because you're not capturing the execution demand anymore. These are all captured by the L2 execution layer.
Fair enough. But you think with wallet account abstraction and chain abstraction, the gas assets of L2s change, or any asset can be used as gas on L2s?
Yep.
But isn't that like contradictory to cementing each position as that, or I don't know, each standard or gold standard, whatever you want to call it?
I don't think it brings further marginal impact because the fact is most of the demand for ETH right now at 300 billion valuation are not for the gas usage anyway, because the gas usage are so minimal. Like the demand that sustains ETH at 300 billion valuation is really as for ETH as a programmable money, not for the gas demand. Yeah. So I think even with account abstraction, because people are not really owning millions of ETH for gas.
But what I think is, as you start going further and further away from the user, like for example, we don't care about TCP/IP, right? But everything runs on it. If something like that happens to ETH and it is out of mind for users, like does that impact its valuation? Like that's something that I've been struggling with.
I think in the long run, it might not be that good because you usually want to be closer to the user to capture the value. I think this has played out very well in Web 2. But I think in the short term for Ethereum, it doesn't matter as much because the brand name of Ethereum is definitely still way stronger. But if you're talking about like a 5 to 10 year kind of horizon, yeah, I think it starts to matter.
I think on the Web 2 point, there were a lot of DNS companies and a lot of router companies in the early 2000s that were listed companies that went down like 90% over the next 5-6 years, right? I think one way to think about this whole gas conversation, I am dumbing down way too much, is think of it like bandwidth. We're like in the 56 kbps era of ETH being able to do X number of TPS per minute. And with L2s, you've just scaled it infinitely. Does that mean does that mean it accrues value to ETH over time? The answers are not very clear there yet.
Yeah, that's fair.
Yeah, agree.
Right,
yeah,
and
exactly.
It could go all over the place. Right, there is is there a world where there are L3s and L2s, but ETH is trading at $1,000? In my mind, there is. It's probably not a very pleasant answer, but yeah.
Yeah, exactly. I think that the biggest issue is the success of Ethereum as a technology platform might not be correlated to ETH as a valuable asset, and that is a dangerous relationship. Yeah, if Ethereum is gonna commit toward this path.
I think you really hit the nail on the head there. Yeah.
Simplest instance in base, right? If we saw basis metrics in 2020, we would have lost our minds. And in 2024, we just take it for granted. Just like, that's nothing.
I mean, even for Web 2, right? Things that were used for infrastructural improvements back then. I mean, take a simple case of fiber optic laying companies. Back then, those were valued at billions of dollars, right? Companies that laid like transatlantic cables and whatnot. But as the internet evolved, like no one cares about them. They probably went bankrupt as time evolved, right? So, yeah, I mean, I
just pulled up a chart, and that's of Cisco's. In 2000, its all-time high was $80. And it's been trending upwards, like it went down all the way to $9, and it's still not recovered fully. Like Cisco was one of those hot stocks because they were, at the forefront of infrastructure back then. And that's why I pulled it up. But yeah, to your point about infrastructure and value capture.
Exactly. And then also, you can also look at telco, right? I mean, over the past, 2 decades, like the cost of data have consistently come down, and the speed have consistently increased, but the telco valuation have not went up. I think some of that are like stagnating. I'm not sure the AT&T, Verizon valuation, but I don't think they are really climbing or outperforming S&P. But what really captured the value are, the macro at something that's below 20 billion valuation. But if we are at 300 billion valuation, I think that's a different story, because there's a new set of market audience. You need to convince them of this story between the relationship.
Arthur, you guys wrote an extensive thesis on gaming. I think that was a couple of years ago. And I think you found out 3 parameters or framework for finding good games. Like one was team pedigree, the other was product and distribution, and the third one was economic sustainability.
Yeah.
Like, have you revisited that thesis? Like, are there any games that fit the bill? How has the whole gaming landscape evolved since you wrote the thesis?
Yeah, this is gonna be probably one of my...
To put him in the spot, sort of.
But the hardest thing to say, because I think some of the gaming startup I invested in, I'm not going to be happy to hear what I'm going to say. But yes, we have been re-examining the thesis. I think what we mostly wrote is still correct. I think those are the quality and traits that we want to see for Web3 gaming to take off. And I've just been playing a lot of Black Myth Wukong recently. I was like, I think one of the most successful AAA game to ever come out from China. Actually, it's the first AAA game any Chinese student ever tried to make. And there's just a lot of epiphany and the realization that for a lot of the consumer stuff, it's also broader, not just in gaming as well. I think that over financialization of many consumer things actually makes it even harder for you to distinguish whether you have real product market fit or not. And the problem is, if you have not really found real product market fit and you have been putting a huge ton of resources, it's very dangerous for the entrepreneur, for the team, because you're not really sure what are actually working out well enough for you to devote so much resources into it. And I think that's the problem with Web3 gaming, that we actually, the initial success turned out to be really mostly due to incentives. And nobody has been able to make a game that's in itself fun without relying on incentive and still show a very sustainable a metrics. Yeah, I think we have seen some limited success. I wouldn't say no, but these limited success are not enough to get crypto investor excited. We have seen Pixel, Ronin consistently have 2 million daily active users, but look at the valuation they are getting versus some other layer one. So I think that there's a few ways to reconcile. We think that, first of all, crypto investors just discount gaming sector as a whole, especially on the public side. And I think that another factor is just that I think the crypto gaming industry have not put out something that's big enough to really convince the market to change its view yet. Will that change? Because if you look at all the funding history, Web3 gaming actually took in a lot of capital over the past 2 years. I think collectively we must have funded at least 20 billion or 15 billion into the Web3 gaming industry for the past 2 years. And I think, so you can't really use money as an excuse anymore, because I think that we have given the industry enough money to try different things out. So we probably have another 1 to 2 years to see whether that all this investment, are they going to bear fruit or not? Because I don't think you're going to see another wave of VC dollars or investor dollar going into Web3 gaming again if this doesn't get proven again in the next 2 years.
I think I have some views there, right? I think the most best thing I did for my Web3 gaming conviction was playing Red Dead Redemption, because it's just such a beautiful game. I was just like, unless I have something close to this, I'm not doing it, right? I think, to Arthur's point, a lot of Web3 gaming studios may not race for games, but they will say, hey, we have the data availability layer for games. Or they might just, package the same thing in a different way. They could be like, hey, we use AI, but a blockchain verifies, who created what within this game. So I've been seeing some elements of that, but I think the fact that Arthur thinks no VC dollar might go into Web3 gaming, I think that's profound. I never thought of it that way. Instead of capital, maybe a lot of people will use time as the excuse, because a lot of good games take years to build. So the running argument that I've seen is that we need more time. That's just what I've seen.
So basically, when your app is not successful, pivot to infrastructure?
Yes, that's the app chain thesis, right? I mean, hot thing right there, but that's the core of the app chain thesis.
Yeah, and there's also kind of like a meme, right? In crypto, it seems like more and more common we are building like a dev to dev business. Like the people are building for other developers in the industry. Yeah.
All right. You recently wrote a thesis on Aave, right?
Yep.
Like what I've started thinking is eventually like the DeFi primitives, like lending, etc., they should come close to what their valuations are in the TradFi world, right? So for example, lending businesses, just because they are crypto doesn't mean that they should receive a higher multiple, right? I don't know what you think about that. So first is that, and then can you walk us through your thesis on Aave as to why, what do you guys think?
Yeah, I think the first part about valuation is, I think that at this stage, because of how small the DeFi industry is, you don't have to see valuation multiple converge, because there's just a lot more growth for the DeFi
eventually.
industry.
Not right now.
Finance,
Yeah.
right? Like for JP Morgan, it's already the largest bank in the world. Like you can't expect JP Morgan to double unless the economy double. But I think for DeFi, we can still see a lot of exponential growth, assuming the rest of the world remain the same. So I think that's why I don't think the valuation multiple should be the same, because you still have a lot of growth potential. And a second thing is a lot more scalable for DeFi to growth compared to every other financial services, like even compared fintech, traditional finance, like because the marginal cost of DeFi to scale are very low. Like
Right.
Aave with the same code base, as long as let's say ETH went to 5K, Bitcoin go to 100K, stablecoin supply triple or double, Aave the market size will just increase. There'll be more users using it, and Aave doesn't really need to lift a finger, right? I mean, the business model itself is a lot more scalable compared to fintech and compared to traditional finance and banks. Obviously, in some side of the fintech, there is some more scalable model, but I think that we have seen that is not the case. I mean, fintech as a sector is kind of like facing an existential question on the multiple side, that they are not really getting a good valuation multiple anymore. And because what people have realized is fintech is actually just putting like a nicer front end on the traditional finance rail.
Right.
They're not fundamentally changing anything, and you're also over time as you get bigger, you are still inheriting the legacy cost structure of traditional finance. Yes, you probably are reducing their margin, but is that really the pitch that you want to sell to the investor? Yeah, we are competing with the bank on the margin, and that's not really the best pitch you want to say, right? So I think, but DeFi actually doesn't have this issue, that the marginal cost of scaling is very low. Like you can scale quickly if you are able to get the product right. And I think this is what drive DeFi to grow so explosively in 2020 to 2021, right? The marginal cost of scaling is very low. So I think that addressed the valuation multiple point. The second thing is, I think the Aave thesis is very straightforward. I think when you look at crypto as a whole, like what really had product market fit on a more sustainable scale, decentralized money, Bitcoin, stable coins, finance use case, speculation, fundraising, which is all kind of related to finance in some form, right? So the rest, we see early signs of product market fit, but not at the level that you are comfortable that it will continue to exist in 2 years or in 5 years, right? I mean, for DeFi, I'm very confident it will exist in the next 5 years. It's just that would it grow like 10 times bigger in the next 5 years? So the question I'm asking myself when I invest in DeFi is like, can it grow beyond here, but not like whether it will exist? But for other sector, I need to go past the first question. Will it still exist?
Will it still exist? Yeah.
2 years later, 5 years later.
Right.
Yeah. So I think that means that I have a lot more confidence on the DeFi as a sector. And I think DeFi also are going through like a classic Gartner hype cycle. The 2020 DeFi summer, we have the peak of excitement. And then obviously then we see all the hacks and all these issues start coming out. We are coming out from the trough of disillusion. And I think that in the next few years, we are probably going to slowly go to the enlightenment phase when people are going to come back to the basic. Okay, fine. I mean, it's probably time to admit that blockchain is still the best optimized for finance use cases. All the other use cases, it's interesting. We should continue to keep trying, but we should acknowledge that finance is 100 or 1,000 times bigger use cases than every other use cases on crypto right now. And I think that is what's going to happen when people realize finance is by far the largest use cases. And you were going to see according repricing on the leader of the certain DeFi sector as a whole. Yeah. And also, it's just also on a relative, right? Because when you see a lot of infrastructure projects are getting like 10, 20 billion valuation with very little adoption and relevance in the industry, and Aave is just trading at 1.5 billion valuation and like one of the most important primitive in the space, I just think that there's a lot of room for catch up in valuation, and also on an absolute basis, a lot of room for growth. Yeah. I think that's the essential part of the thesis.
Okay, so you've been observing DeFi since a long time, right? 6-7 years at least. So what changes have happened in these 6-7 years that make you bullish or confident that this sector will stay and grow?
I think it comes down to first principle where we are storing more and more of our wealth on chain in the form of digital asset, Bitcoin, Ethereum, stablecoin, and you need financial services to service these assets. Yeah. So I will be bearish DeFi if we product market fit and just outright accelerating. So as long as the size of the total on-chain asset keep increasing, I will always continue to be bullish on the growth of DeFi because it is just correlated.
Yeah, but these are like exogenous factors, right? Have you seen anything endogenous to DeFi that, okay, these primitives have changed or certain things have changed, that whether the UX has improved and so on?
All of them. I think first of all is we pour into a better security practice and better way to prevent exploit over the past 2 years, because we all recognize it's a huge issue. Like I think recently you see a cybersecurity firm called Hypernative that raised a huge amount of money, tech exploit before they happen. So that's kind of their pitch. So I think security will improve, and I think the UI UX of all the on-chain stuff are going to use smart wallet, secure, just like how you secure normal Web2 logins, like email, password. I think that the technology is there to solve this, and I think that you will get massively adopted in the next few years. So this is really bullish for anything that require on-chain interaction. And I think at least anyone who went through the past 2 years know what is the unsustainable practice. So I think that it's too early to say, but I think we are not going to revisit all this unsustainable Ponzi stuff anytime soon. At least I don't think there's an appetite for any of those in the near term.
I mean, okay. the counter argument to that is the unsustainable Ponzi's are here in, clear sight. It's just that we don't look at it. Like Pump Fund, for instance, I was just looking at a metric. It has 2 million tokens launched. Only about 92 of those tokens ever reached an FTB higher of $1 million. Right? There's something to be written there. We will be writing on it soon. But I'm just saying that the Ponzi's are here. Maybe the old, folks in crypto just don't see it that way, is what I would say. We maybe grown out of that Ponzi, that Ponzi is catering to the new era of crypto is what I would argue.
But I guess one thing about Pump Fund, I agree. I think this is definitely a big bubble there, and Ponzi, probably Ponzi is not the right word, it's a bubble. But I think at least anyone who's doing Pump Fund come in with very clear expectation that they are most likely going to lose money on 99% of the meme coin they do there. But I think the problem with DeFi is there's a lot of false promise, right? Like Luna and a lot of things were just marketed as something sustainable and legitimate.
That was the genius of Luna, right? It was marketed as just too good to be true, right? Like right at that sweet spot. Yeah,
but for Pump Fund, nobody is really trying to market it that, okay, this is legitimate, this is going to change finance. I don't think, advertising.
It's like a lottery ticket from many people, is what I concluded after studying it.
Right, like they're not representative of what DeFi is, right? Like that's very clear at least in my head.
They make the most revenue. So if you're ranking by revenue, you have to argue that it is representative of
but
DeFi, right?
Again, you are looking at it from a very short time period perspective, right? If it continues for the next 5 years, we'll probably revisit it.
We'll have to pull up stats. Like if I just look at how many DeFi primitives in the last 3 years made more than $100 million, maybe Pump.Fund would be there in the top 10, right? But I take your point. I'm just saying in terms of, we can't discount it as easily.
I guess one thing we just kind of have to accept is value created and value capture are probably very different things. And
that's fair.
That's fair.
Yeah. So on value captured, I think Pump Fund will be featuring right somewhere in the top. But in terms of value created,
Fintech is likely the all-time high, right? Captured 50% of all fees ever. They made like $52 million with that.
Yeah, but for Fintech, I think it's still a bit different. I wouldn't put Fintech and the Pump Fund in the same category. I think Fintech was, I think you would write an article about it, but it's just a lot of things that could have went right, but did not went right. right?
So my honest view is it got an air of legitimacy because certain large funds were involved, and nobody called out the fact that the keys were not given back to the community. If it were given back, because my core thesis was that eventually the community would take over it. And if that were the case, I would be massively bullish. And it still can happen. The reason why it's not happening is Machi owns like 9% or 11% of supply. So it's entirely dependent on how Machi decides he wants to run the product at this point. So it's a very interesting case. It's not sufficiently decentralized is what I would argue at this point. Like, we're taking aside the fact that fees were taken off, the keys were burned, all of that.
I mean, despite 9%, 10%. Oh, go on, please.
No, but my point is Friendtech could be a
lot bigger
value extractive project, but unfortunately it turned out to be a value extractive project. But I think Powerfund was always gonna be, you know what you're getting, right? I mean, they didn't force promise you anything. It was very clear. What are you getting it into? Yeah.
So one interesting stat on Pump Fund, actually we have a tweet going out in like 3 hours. 65% of all transactions happening on Solana comes from Pump Fund. So purely checking, DeFi transactions on Solana. So purely checking from a PMF or stress testing the system perspective, Pump Fund is tremendously valuable, I would argue. Just like Fintech was for base at some point, but
Agree.
All right. Joel, do you have anything else? I mean, we can talk about infra, app chains and all of those things, but I don't think we have that much time.
We're way over time.
We are over time. So Arthur, thanks a lot, man. I mean, this was a lot of fun. Yeah, thanks for spending more than an hour with us and entertaining our questions.
No, it's my pleasure. Really enjoy the conversation, and keep up the good work. I really enjoy what you guys are doing.
Thank you.